Now, any cash flow projection starts with a number off of the income statement. In this case, it's net income. It is the net of all revenues and expenses. Depreciation, we're going to add back. So the sign for depreciation will be a positive sign here. It is implicit in the cost or the expense items in our balance sheet. And you can think of it as perhaps a big portion of the fixed cost of sales that we calculated in the monthly budget previously. Here it is on the assumptions sheet, and we simply pick that up and add that back to net income. So implicitly in net income, depreciation has been taken out in one of the major expense lines, probably cost of sales. There may also be some depreciation in SG&A. We're not going to worry too much about what that is because in this case our depreciation is quite low. Our deferred tax expense, again, has already been calculated for us miraculously, so all we have to do is pick it up. In this case, our deferred tax expense appears to be a negative number. We're adding back depreciation and we're adding back deferred tax expense. The reason for that is we're trying to get at what the cash flow is off of the income statement. And if things have worked out correctly, cash from operations should be equal to pre-tax cash flow plus depreciation. And since we know depreciation is de minimis, we should be able to check that roughly by looking at cash from operations, comparing it to our pre-tax income, and there it is. They're quite close. We appear to be on track. So the cash from operations appears to be somewhere in the range of 2.7, and there's some rounding going on in the second decimal point that I really don't want to get involved with if I don't have to. Capital expenditures, again, we saw this previously off of the assumptions, and it's already incorporated in the balance sheet. In this case, we want our capital expenditures to show up as a negative number. So we take it off the assumptions, we do we make that an absolute cell reference and include it. The increase or decrease in working capital excess, except for cash, we can use our prior calculation to get to fairly quickly. Since it's the decrease or increase, we're going to look at this year's sum for working capital minus the prior year's sum. And you can see, as we discussed earlier, he's going to have to invest $1.2 million in his business in the first year. Now, because I want that to be a negative number by convention, since it is a negative cash flow for him, I'm going to make it a negative cash flow by subtracting the quantity of the sum. And then simply add up capital expenditures and investment in working capital to figure out what is going to have to be invested in operations outside of the income statement. Now, this is the number that most cash flow forecasts neglect to include. In fact, most of them will look at income statement items, they'll look at capital expenditures, but they will forget about the fact that there is actually a significant amount of investment required in working capital. This model more or less forces you to remember that, and that is one of the many reasons why we're using it in this class. Now, the equity financing raised, we've actually already figured that out. The equity financing that he hopes to raise is, back here in the assumption, his seed round of $5 million. Now, he may raise money in the future, and we're going to get a little bit fancy here with an if statement. We're going to say, if in the year of this forecast, the assumptions say that he is raising an A round. I'm going to make that an absolute reference. So if he's raising an A round in this year, whatever this year happens to be, then the equity financing that he's raising is the amount of the A round. And again, need an absolute cell reference. Otherwise, if, for example, this is not the year that an A round financing is schedule, then he's going to raise $0. And with that statement, let's just play with that for a minute and copy it forward for future years. We have assumed that there is no A round here after a seed round, but this logic should allow us to have an A round if we want one. This says in the second year of his forecast, let's just put in a $3 million number and see if our logic captures his raising of $3 million. It does. There's the $3 million. And he's going to be raising a total of $8 million under this scenario. And let's just double check that his equity account goes up by that amount. And yes, it does. It's approximately a $3 million increase. There's, of course, the net of net income and depreciation in that account as well. But it appears that that equity financing has been captured in our balance sheet, all of which is very good. Since we have no debt financing, I'm going to enter that as a 0. The cash to debt repayment is actually the cash that he has available from operations, outside of operations, and from financing sources, whatever they may be. That's the amount of debt. If he that's the amount of cash flow he would have. In this case, it's of course negative in his first year. The amount of cash he has available to repay debt, and of course the principal reason why he doesn't borrow debt. Cash dividends, we're just going to assume he pays no cash dividends this year, or for that matter any other year. We can change that assumption later if we want. And then the excess cash required should be the sum of cash debt repayment and plus cash dividends, where cash dividends are expressed as a negative quantity. Okay, let's replicate all that forward by copying it with the command C, Shift, arrow, 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 and then command V to paste, and we have our cash flow projection. Now, here is the moment of truth. If we've done everything correctly, then we should be able to take this number, our excess cash or the increase in the cash account, and accumulate it into our cash account, and by doing so we should make the balance sheet balance. Let's see if that's the case. Again, we're going to add the previous balance of cash plus the increase in cash account from the year that we are in. And we can see that that gives us a balance sheet that appears to balance. So far so good in the first year. Now if we take that logic and copy it forward, if everything is good, if our stars have aligned, the balance sheet will balance. And if things are not good and our stars haven't aligned, we're going to probably have to chase down a number of signs that we may have gotten incorrect, or sums that we may have done incorrectly, or any number of potential problems. Let's see what the verdict is today with the command V. It appears that we're in luck. We seem to have gotten all of our signs right. There is at least internal consistency in the way we've constructed our balance sheet and our income statement, and the total asset line does appear to be equivalent to the total liabilities and equity line.